CPI comes in soft this week, gold should explode. Silver should really explode because it's an industrial metal, because it'll move more like stocks. And China is already issuing more debt to get their economy going. It could be a big week. Looking at this pre-CPI, whatever's happening between now and Wednesday doesn't mean anything unless you're trying to put a position on. So if you're like, oh, I think CPI is going to be low, I want to buy gold. Well, then the dips will be a gift to you, right? If you think CPI is going to be high and the market rallies going into CPI, then that's a gift to you as well. You want to sell your gold out, take your profits.
The Consumer Price Index comes on Wednesday. The CPI is up 0.4%, compared to the March report showing a rise of 0.4%. The annual CPI April reading is up 3.6%, compared to 3.8% in the March report. Gold and silver prices modestly rose in early U.S. trading Tuesday, following a U.S. inflation report that saw hot headline numbers, but the internals and revisions to the report were cooler. A seasoned figure in financial circles, VinceLanci brings a wealth of experience and a sharp analytical eye to precious metal market trends. In this video, Vince emphasizes the importance of understanding market dynamics, especially regarding gold and silver prices. About this week's CPI data, he holds the view that should it indicate softness, gold prices might witness a significant uptick. Over the past century, gold has consistently been a beacon of potential stability and a mirror reflecting global economic fluctuations. According to many analysts, gold is expected to increase in value in 2024. Factors supporting this rise include ongoing inflation concerns, the weakening of the US dollar, and increased demand from central banks. With regard to silver as an industrial metal with a tendency to move alongside stocks, Vince predicts that it could see a more robust surge if the CPI data shows softness. He also highlights silver's relative strength compared to gold, suggesting that it could offer better trading opportunities in the current market. The silver market continues to capture the attention of investors and industry stakeholders. Silver has risen strongly since bottoming at the beginning of May. It has broken above the last higher low of the downtrend and breached all the major moving averages. While Vince interprets UBS's statement as bullish on gold, reaffirming their target of $2,500 per ounce. Despite UBS's seemingly dismissive tone regarding miners, Vince found their recent inclusion intriguing. Now, we present the clips of VinceLanci's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I said on Sunday with the GoldFix Founders class group, I should say, these are the lines I've had here before. Said, it's kind of disheartening that we got above here and didn't close into there, and I would be bearish below this line, and I would look for it to flatten out in here. So if this area holds, then the market rotates higher. Technicians will just say, oh, look, it's a bull flag, and they'd be right. If it doesn't hold in this area here, then look for this whole range to be retraced. Now, that said, I don't care about that information I just gave you because all bets are off when CPI comes out, right? When CPI comes out, whatever the market does, it's going to do. And then you look at your levels to trade. You don't use them for predictive behavior. Silver up 2 cents now, right? There you go. So silver had a bigger rejection of its level, but it got to the level that I said it would get to. Then I said it has to get above this to test the final boss, right? Well, we have a retracement. So, if you look at the silver chart, that's a healthy retracement, meaning you have a long wick, it looks like shit, and now you have a market that's holding its own. So gold looks worse than silver, and that's what's telling you. But I would say, if you're looking at this pre-CPI, whatever's happening between now and Wednesday doesn't mean anything unless you're trying to put a position on. So if you're like, oh, I think CPI is going to be low, I want to buy gold. Well, then the dips will be a gift to you, right? If you think CPI is going to be high and the market rallies going into CPI, then that's a gift to you as well. You want to sell your gold out, take your profits. UBS, a second win for gold. Our view, while gold prices have faced some recent rate-related headwinds, we have retained our bullish forecast and expect gold prices to rise to $2,500 an ounce this year. Some investors may also consider structured strategies to purchase gold at levels below our forecast trajectory 6 months out. Gold miners are another way to express this view, though through equities, though they are more tactical in nature. There's a lot in that paragraph if you know how to read these things. And at the bottom in premium, we tell you exactly what that means because it's a very specific type of statement and we translate it for you. Keeping it simple, it's bullish. They're surprised at last week's behavior. Now, I understand why they're saying that. And they're telling clients to buy the dip. And now miners are on their radar. Don't worry that they said it dismissively with tactical in nature. Miners are on their radar. That's very interesting, I think.
In his discussion on the present economic environment, VinceLanci delved into the significance of the CPI data. Highlighting recent trends, Vince pointed out the surprising strength in CPI readings, which has countered expectations of deflationary trends. He underscored the potential impact of a soft CPI report, suggesting that it could trigger notable shifts in the market, particularly affecting gold and silver prices. This discussion ties into the historical context of gold's performance. Over the past 50-plus years, the inflation-adjusted price of gold has exhibited a consistent upward trajectory. It has managed to keep pace with rising prices during this period, notwithstanding intermittent periods of volatility. Since 1971, periods characterized by price inflation have posed challenges, and during these phases, the price of gold has not only served as a hedge against inflation, but has also outperformed the rate of inflation itself. Additionally, Vince highlighted China's increased debt issuance to stimulate its economy as a factor that could further influence market dynamics. Let's get back to the interview.
CPI has been surprisingly strong the last 4 months. I'll just read some of this to you. I wrote this today. So last week, markets reacted to economic data that showed a slowdown in productivity, indicating a recession was inching even closer. This week is CPI. The last few data releases had come in stronger than expected, indicating the deflationary impulse that started when Powell began raising rates was dead and gone. If you look at that chart there, if you're trying to figure out what you're looking at, the red line is what happened, and the bluish green line is what they expected to happen. So for this whole square, it's a zero hedge chart. This whole square here, they expected that, they got that. They expected that, they got that. So every month it's been higher than expected. So people are going to be talking about it in that framework of expectations of another higher surprise. If CPI should surprise by coming in softer this time, there could be a very real fireworks display. Meaning, based on the momentum of economic data like productivity, unemployment, the economy is now rolling over again. All the stuff we sold last week says all that good stuff we were seeing about the economy rolling over, we're talking about higher, has peaked and is already turning down. Also, 2 weeks ago, Powell admitted he expects to lower rates at least once this year. With the soft data last week, if he gets his soft CPI data this week, if he gets that, then the market's going to explode. So I'll read a little bit more what I wrote here. By his own admission, Powell and company expect to ease this year at least one time. The market expects this to happen in July now. Now, why would CPI come in soft after all that, those 5 months in a row overperforming? Well, there's something called OER, owner's equivalent rent. That doesn't show up that big. I'll put it back. And owner's equivalent rent is what people think they can get for their real estate if they wanted to rent it. And it's really not a very accurate data piece individually, but month to month, it shows trend very nicely. And it kind of lags. So I'll show you what I'm talking about. The thin, dark blue line, that's the real data. And the light, wider line, that's the real-time anticipatory data. So the OER itself, the thin line, lags behind the data. So certain banks, Zero Hedge and ourselves included, believe that the OER will come in very weak this month as it catches up to that blue line there, the light blue line. And you could very well have a surprise lower in CPI. So Powell was, back to the script here, Powell was uncharacteristically optimistic at the FOMC press conference, saying inflation will get to 2%. We and others like Standard Charter think the data supports his optimism. If CPI were to come in soft, and it could, given certain data points, which I just described, then you'd likely see a risk-on type of move where stocks, gold, and this time, even bonds rally. Everyone on the street that writes about this stuff is saying CPI has been hot every month for the last 5 months. If it's hot again, it's going to be a disaster. And that's true, but they're only writing about the past. They're not looking forward or looking at the data for the future. Admittedly, it could come in hot, sure, but to just blindly say that, because that's what the mainstream media does. All right, if CPI comes in soft this week, gold should explode. Silver should really explode because it's an industrial metal, because it'll move more like stocks. And China is already issuing more debt to get their economy going. It could be a big week. Incidentally, PPI is on Monday. I'm sorry, Tuesday. That doesn't have anything to do with CPI this week.
As we explore the intricate dynamics shaping the future of gold prices, it becomes clear that various factors, including economic data releases, geopolitical tensions, and central bank policies, will play pivotal roles. Given the multifaceted nature of the factors influencing gold prices, what are the most significant drivers of gold's future price movements? And how do you plan to incorporate these insights into your investment strategy? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.